Hello and welcome. Good morning, good afternoon. I am Meg Pekarsky. I'm a partner here at Husch Blackwell in the Healthcare Practice Group, and I'd like to welcome you to our sixth webinar in our 8-part series on health law and innovation. And before we begin, which in what I know is going to be a very lively conversation, I did want to cover a few housekeeping notes. First, I wanted to point out that on the bottom of your audience console, there are multiple application icons for your use during today's program. If you have questions during the webcast, please submit those via the question box, and we will do our very best to try to answer those questions during our live broadcast today. But if a fuller answer is needed or we run out of time, which for some reason I believe we're just going to have a lot of questions for this great panel, we will follow up with an email. And then there's also a PDF of the presentation in the resource panel or tab. And then I can't ever do a presentation without doing a handout. And so we all put together sort of a quick hits handout for you that hopefully will be a helpful tool and takeaway for you. For those lawyers on the call, this has been approved for legal education hours. So to report your hours, click on that CEU icon at the bottom of your screen, and then you'll get a certificate of attendance, including course numbers, will be emailed to you tomorrow along with a recording. So if you do have to dash out, you'll get a full recording of today's session. And then towards the end of the program, you're going to get a short survey. And so if you can provide feedback, we'd love to hear it. We use it for our planning. And that's it for housekeeping. I wanted to now just jump in and introduce our panel for today, which is really exciting for me, which is first, I'd like to introduce Dan. And Dan and I have had the good fortune to meet over the provider relief funding issues. So Dan Yunker is at Crow LLP, and He's been practicing for over 28 years in healthcare. He serves as the principal, leading the strategic direction of healthcare internal audit practice and risk services and solutions within healthcare consulting. And Dan, I have to say, I don't know exactly what all of those things mean. All I know is that you know a ton of stuff about stuff that I know nothing about. So you've been a great person to partner up with. And then I'm pleased to have my colleague, Allison Hollander, who works in our healthcare group, and she counsels clients on licensure and certification of healthcare facilities and regulatory compliance and operation issues. She deals with Medicare and Medicaid reimbursement and helps with corporate healthcare transaction. She works with both individual healthcare professionals as well as hospital and health systems, as well as ambulatory surgery centers. She also helps clients with licensure and accreditation of new facilities, relocating facilities, like merger, like Allison does it all, is essentially. But what I want to say, but the most interesting thing I did not know, Allison, was that you started your career working at Cook's Children's Healthcare System, and you earned a master's in healthcare administration. So thank you so much for joining in the presentation. And I wanted to now jump into getting to know our audience here a bit more. So our first poll question is, what sector of healthcare do you affiliate with? And that should be up on your screen. So if you could let us know. We have hospice and palliative care, hospital, medical practitioners, and ancillary services. And so we'll give folks a few moments to answer. I've been told I cannot move through this slide quickly or else we're going to get bad feedback. So I will be patient, but I think this will give us a great sense, and we can tailor our comments and discussion to who's on. So hopefully you've had enough time to provide your answer. Let's see who we have here. Oh, look at, we have 30% hospices, 25%, hospitals, we have long-term care. Wow, a really great, healthy mix of folks. So wonderful. So next question to learn a bit more about you all is, from a tax status standpoint, are you a not-for-profit or a for-profit? And we ask this question because one of the things we're going to be talking about is the auditing that's going to be required, and that can differ depending on your tax status. So those of you who, if you could respond to that, that would be terrific. So tax status there. Are we going to take wagers and say 50-50 here, or we'll see?
25-75.
Ah, okay. We'll see if you're right, Dan. All right. So I'm going to move on. Let's see. So 70% not-for-profit and 30% for-profit. This is, if you were thinking we're going to have more nonprofits, Dan, you're right. Or were you thinking the opposite?
Yeah, I was thinking NFP.
Okay.
Versus investor. Yeah.
So, but still, I think a great healthy mix. So last question here before we jump into covering a really rich agenda here. So last question, and Dan helped us formulate this one to be accurate. We wanted to get a sense of what you're thinking you're going to be using your CARES Act money for. Is it mostly lost revenue? Is it mostly lost expenses, or are you going to do a combination sort of in between? Do you have a better way to explain that question, Dan?
Well, it's changing by the month in guidance, right? So, I think that's the nuance we're looking at here. And, hopefully today the audience will be able to walk away with a couple nuggets of what it means today. And not that it may not change, but I think we ended up in kind of a landing spot. So what it means today. So it'll be interesting to see what people think.
Great. So let's see what we have here. So most people are having a combo and evenly sort of split there. So, well, fantastic. That's great information. Let's dive into the roadmap. And because this was a panel discussion, I really didn't want to have a lot of slides because our panelists are really exciting to listen to. And I think I didn't want to ruin our flow with having to move a bunch of slides. So I just created this roadmap slide. And I guess where I wanted to start is not at the very beginning because we don't have like 2 days to go back to March. But I think, Allison, maybe you could start us out with, there's been some pretty significant changes in the last few weeks, and maybe we can level set right there.
Yeah, Meg, you are correct. I think that there has been significant changes in the last 2 weeks. I think when we're looking at the guidance, we first look at the FAQs that we check on a daily basis because they're issuing, HHS is issuing new FAQs every 2 to 3 days. And then we also look at the reporting guidance that HHS is issuing for those reporting requirements for providers who received $10,000 or more, or who will spend $10,000 or more. So on October 28th, last Thursday, there was some significant guidance released on the use of funds, mainly related to lost revenue, but also a big one that I noticed, and Dan, I want you to chime in on this with your accounting insight, is just that they're going to require the depreciation of capital equipment with a useful life of 12 months or more. So I know we had a lot of providers who were saying, I need to make maybe a change to my gym to allow more space between patients, or just these equipments that were going to be longer than 12 months. And now it looks like that may significantly change their plans. Dan, what are you hearing about that just with the depreciation?
Yeah, that's a good point. That is some clarity that just came out. And first of all, before you get going, I just want to welcome any Crow clients that are out there. It's great to be with you. Welcome anyone that's been on one of our prior webinars we've done together. It's great to be with you again. And for all of you that are new to an acquaintance today, it's nice to meet you virtually, anyways. Hopefully, we get back to a world where we can interact face to face in some setting, right? But it's a really good question that we dive into from an accounting standpoint. So there was a lot of openness in this of how do we incur the expense? Because typical grant accounting would say that you've incurred the expense, you expended the funds, and that you would just you would draw down basically that grant fund, and you had a budget for a certain amount of a certain expenditure that was typically capital related. The guidance now, and we're still dissecting this, is the trade winds are really shifting to the use of life cycle use. So that would be your maker's tables of life cycle use of that particular asset and the depreciation thereof. So it clearly is something to pay close attention to. And I think that the guidance will further follow through this. But if you think about it, it's not only the 12 months, right? Because you could have carryover of proceeds used for into the next, calendar year. So it could be a little longer than that, but it is something to be very mindful of. So but it's definitely a recent change.
Yeah, no, that's really helpful. And I'm going to save the big doozy of lost revenue for a second here. The thing I also wanted to talk about before we get there is expenses. And so the standard that we've had since, is it March or April, was you can use your funds to cover expenses that were made to prevent, prepare for, and respond to COVID. And so I guess for you all, have you seen big changes in that? I mean, initially that statement came out with not a lot of examples, and then there's been more examples. I guess any surprises there for you? Anything new in the FAQs?
Allison, did you want to start on that?
Yeah, so I think what the FAQs are doing, and also the guidance that was released September 19th and then subsequently revised on October 22nd, and then again revised on November 2nd about reporting, is that they just continue to give us further examples of what's acceptable. But I will bring up a point that in the guidance it will say, or other expenses, to respond to, prepare, and fight COVID. So while it whittles down our allowable expenses, it then there's always like a catch-all, and you're like, well, if you have other stuff, well, COVID, it could be acceptable.
Yeah, well, and I agree. And I think that hearkening back to one of the very early presentations you and I did, Dan, and with some of our teammates, we came up with this, but for COVID, would I've had this expense? And I think, not to pat ourselves on the back, but it's actually that particular catchphrase has held true. I guess from your perspective, Dan, and what you see in the FAQs, would you say that's true? Like there isn't surprises of things they've carved out from an expense standpoint?
Yeah, I totally would agree. And it's that litmus test or whatever, snicker test, whatever, that we kind of craftily created, right, out of doing these things, which is pretty fun to be part of that. If you just kind of go back and, we've made this major shift from reasonableness testing, right? So we're use of proceeds, and how are we reasonably accounting for the fact that these are expenses incurred or lost revenues because of COVID. And so that was kind of the starting point, as guidance wasn't as necessarily clear as we typically are used to in the auditing world. Then we went also in this seismic shift in September, as you know, to this net operating income model. And everybody got behind this, right? The American Hospital Association, the Hospital Association, all the state associations. And I have the fortunate opportunity to participate on a lot of HHS calls, especially in Region 5, in examining and where is this going and what is the intent here? And it's not always clear. But one thing that we were hearing was, well, there's a lot of backlash on that approach. So we're probably going to see some changes in there. As we know, election years, we all have experienced this week and so forth. And we saw it revert back, but it didn't revert back to the prior of, reasonable accounting. It reverted back with some clarity. And that clarity, I think, is just like the depreciation example we just discussed, that's a clarity. But also another clarity was the cadence of how you actually apply the accounting of the use of the per funds. And Allison alluded to this. So, first you have your expenses. So you look at expenses as, incurred because of coronavirus. The simple ones are the PPEs and so forth, really simple math there. But there's a lot of other nuances and based on the type of organization you are, there's always specific, kind of things that we hear about every single day, whether they're rent or mortgage or lease or whatever related. So that's first. So we get this flow, this clarity on flows. First, you apply expenses. Then you have to look at those expenses. And if you're an organization, for example, that delivered or made an investment in delivery of a temporary testing, drive-through testing facility is always a good example that comes up, and you actually applied for FEMA funding because that would have been an expense that you could get some additional emergency funds for, and you received those funds, well, that covered 70% of that expense. So that is an expense that you incurred because of COVID. Clearly, you created this drive-through testing facility, tent testing or whatever people are calling it. But you also received another source of funding to cover the expenses associated with that. You have to net that out, and now you've got your remaining 30% expense you can apply towards the PERF funding. And then lastly, then you get into the cadence of this is into the lost revenues. And we'll have some additional nuggets later on when we're talking about that, because there's actually some expenses tied to lost revenue for consideration as well.
Yeah.
And just on that point, Dan, I had a few clients ask this, and so I just always want to emphasize it. They say, well, if we use all of our money for expenses, do we even have to report our lost revenue? And the answer is yes, you still need to report that information. HHS is data gathering. So even if you can allocate it all to expenses, you will have to go through the trouble to report your lost revenue as well.
Plus, on that note, Allison, is really important. It's like there's reporting requirements beyond expenses and lost revenues as well. There's metrics. There's a metrics section, and that's the population you're serving and so forth. So that is another term and condition requirement.
So, one thing before we move on to lost revenue is what's the time period that people can, cover these expenses? Because in lost revenue, we will talk about is what's the period of time that can be a comparison. Is there any element of that for purposes of expenses, like 2019 versus 2020? Is there any comparative, I guess, Allison or Dan, that we need to be thoughtful of? Because we got some questions on that.
Yeah, I think the big thing to know that when you're using your relief funds is that it has to be used January 1st, 2020. HHS said that would be likely the earliest day that they would expect expenses to be accounted for. And you can use them all the way up through June 30th of 2021. That's the big answer. That's your big time frame. And that goes based off of when we need to report data to HHS. So there's a first report due on January 15th of 2021, and that's for your use of funds January 1st, 2020 through December 31st, 2020, or December 31st, 2020. And then there's another report due at the end of July of 2021.
Okay, great. And I guess before we leave, I think, while still a lot of ambiguity, fairly clear in terms of, I guess, relative, right? Because we're going to lost revenue, my head starts spinning. But on the expense side, what I heard you say, Dan, and this is going to tie back to enforcement when we talk about that, which is this whole double dipping thing. And we got some questions here about netting out your PPP loans and which brings me to think about one of the other concepts we talked about early on was, you don't want to be sort of better off due to COVID, right? That the government isn't necessarily giving us this money, so our profits could be through the roof. But I guess any specific thoughts, Dan, on with PPP loans and netting that out?
Yeah, actually, it's a really good one. So on the in FAQs on page 17, which I just pulled up.
What day? What day?
On this is the issuance on 10/28, so just last week. And the nerd that I am, I would actually be able to pull up page 17 here. So I'm really sorry about that.
We love it.
There's a whole section there, classification of items and categories aligned with how provider relief fund recipients maintain their records. So it goes through to talk about, identifying your healthcare related expenses you might receive through other sources. And they reference such sources as direct patient billing, commercial insurance, Medicare, Medicaid, health insurance, program, the CHIP program, other funds received in Federal Emergency Management Agency, the FEMA funds we just talked about, provider relief fund claim reimbursements for healthcare providers, for facilities and testing. So they kind of go through the whole list, and then they get into the area of, which is an interesting one, is vaccine administration in uninsured small business, SBA, Department of Treasury, which then starts to tackle the Paycheck Protection Program that offset healthcare related expenses. So it's that one, those few words right there in that FAQ, that offset healthcare related expenses. So then it goes on after netting other funds received anticipated to offset those expenses. So clearly the guidance, and they give a couple of examples there. So you got a couple other nuances that are going on though. So you have executive level 2 number as well, which is a cap. So say, for example, they use an example here of say a physician or something. I give a table, a physician, and say that your medical director is at $250,000. Well, there's still a gap of the $197,000 to $250,000, which then you can start to account for. Right. So it's that up to amount that you need to net. So it's really, they give several examples. It's on page 17 of the FAQs, which you can get on the HHS site. And the examples, they do a really nice job, quite frankly, much more than I can detail without drawing on a whiteboard here. So
No.
I would definitely encourage people to go take a look at that.
No, that's helpful. And I think I'm glad we were able to touch on that, because I think that given the strong message about enforcement and fraud and abuse issues, that you need to be marrying up all of the different funds that you've received, from different government sources, and be considering that. And when we talk about reporting, I'm not quite sure how the reporting form will guide you through, some of these issues or questions, but I think nonetheless for your own internal worksheet you're keeping, trying to net those things out. So now I want to get to the doozy here, Dan, which Allison and I, this is one that's hard for me to follow all of the nuance around this. And while I understand the changes that were made were very impactful, I think getting your perspective on what that actually means from a boots on the ground. So just so our audience is caught up here. So before we talk about what the flop was, because there was some flip-flopping here, what was the standard before all of this flurry about lost revenue?
So originally lost revenue, there was most organizations, we're providing a lot of review of management statement creation, if you will, and providing considerations. And so what we saw in that process is we saw with initial early guidance, there were a lot of organizations that were being very methodical and under this term of kind of a reasonable accounting. where they're using budget, and they're using either trailing 12 methodologies to say, because there was growth going on in their business, and there were various carve-outs and so forth as it relates to maybe an acquisition or a divestiture of some kind that adjusted, prior year actual experience. Some organizations, a lot of organizations were using budget as a marker, that, and they were creating a defensibility around the budget as it relates to, well, we've been able to achieve our budget, within a, standard deviation the last 5 years, those kind of things, right? So again, we've been stressing, Meg, from the beginning, you and I've been stressing documentation of your methodologies and what are driving your decisions to take these monies, that you receive, that you have in your balance sheet as either a liability or deferred income, and to run those through your P&L. And so, there was a lot going in the prior event, which was really focused on those kind of methodologies. And we saw several different ways of going over it. Hospices, for example, really came up some great formulas in regards to daily census and things like that. So there was a lot of really good, I would say, reasonable accounting practices going on to estimate and quantify the revenue loss during those period of time. And obviously then that totally changed with the net income approach, and now has come back, but it's come back in a different light.
So, and I used to understand that, so I'm all caught up, and that makes sense. And then, then October came and things changed. And because then it moved to net patient revenue, and then it was like you had to net out expenses first. So take us through that a little bit, and then where are we actually today?
Yeah. So today, I mean, you kind of summarized it to where we got to today. So I think you have it better than you thought. So the net income approach, let's not even spend a lot of time on it, because net operating income, because it was short-lived, it was literally less than 60 days. And so let's see where we're at now. And where we're at now is sitting back on this lost revenue definition. The FAQs do a pretty good job, and I think it becomes more clear every day. But the best way to think about it, I think, is it's net patient revenue. It's your gross charges minus your managed care contract allowances, charity care, and bad debt. And that gives you a net number. So you take that number, and the important nuance to understand here is the measurement of that number and what the time period is. The time period is 2020 calendar year. So that means you could have had a horrible, horrendous, challenging, difficult, period of time in April and May and June. But you also had a great recovery in the last quarter of the year. And but because it's looking at the totality of the year as it relates to what you have left over of your perf monies after expenses and how you apply that to lost revenues. Now that period of comparison is to 2019. So it's your net patient revenue number for 2019 calendar year compared to 2020 calendar year. Now, if you have monies left over after 2020 calendar year, then you can apply that to the next calendar year. And that would be quarters 1 and quarters 2, 2021, compared back to the base year of quarters 1, quarters 2, 2019. That's an important nuance to understand, the way that the guidance is currently flowing. Now, where that creates some significant complexities, Meg, is in regards to fiscal year compared to calendar year. We know many of you on the call have different fiscal years, and they're not all calendar years. And so it gets, and I was in a lengthy conversation on this topic yesterday with our external audit team, and we're waiting for the guidance to come out. The guidance from an external auditing standpoint is not there yet. It usually comes out in October, but because of all of this going on, it's been delayed. And so, if we were working on several June year-end closes right now, and those they're delayed because we're waiting the guidance. And if you take it from a lost revenue standpoint, if you think about this for a minute, so you know pretty well what you could have calculated from expenses incurred, net of other sources and all those things, right? But it's pretty tangible. Those events happened. Those dollars were expended. The expenses were incurred, kind of thing. Money went out the door, right? Always the way to think about expenses. So, even if you had to say August 31st year end, what you occurred January as expenses, January 1st through August 31st. So you could be pretty confident in your audited financial statements and your year-end accounting that, yep, that's what happened. But what about lost revenues? Like, how much do you have to hold in deferred income, and how much do you have to hold in either deferred income or a liability account of some kind when you don't know what the rest of the calendar year is going to be, which may trigger for a prior year adjustment if all of a sudden you had an incredible spike, right? So we had a very, because it's measured on a calendar year. And what if you were accounting for, let's just say a 20% reduction, but the last quarter of the year made up 25%, or a 10% reduction, and all of a sudden you grew 15%. Your calendar, you would owe money. You would have to be given more money back, which would make you have to go into prior period, take a current period adjustment, or go into prior period and make a further adjustment. So this is one of the most complex issues I see right now on lost revenue and how to account for it in a fiscal year versus calendar year. So hopefully that was a little more clear than mud, but
This is why I love working in teams, because everyone brings a different expertise to the table, and you definitely do, Dan, because I'm listening and deferred income and adjustments, and you've lost me, but we have a lot of accountants on the phone. I am sure that, but I get the concept. And I think before we leave the lost revenue, I do think that there's obviously much to be clarified in this area. I know something that comes up with our hospice clients quite a bit is lost revenue due to fundraising and canceled events and all of that stuff. And you and I have had some conversations about that. Again, not very clear because they talk about patient revenue and stuff. But, this is, I have a reading the tea leaves question, that we'll close out this part with. But I think there's many things that are still left to be explained here about lost revenue. But I think an important thing we did learn is that the government is responsive to comment. It's not formal, rulemaking that's happening and formal comment, but they are responsive to the healthcare community about concerns. Because I think we're all trying to make our way through this, and these are very complicated issues. And so I think that was good to know that people got on this right away, and they pretty quickly backed away. So that was, I thought, a very helpful lesson. Before we leave to talk about reporting and auditing, I wanted to talk about reallocation, because I'm sure a number of our folks on the call have complex organizations where they have a holding company, a lot of subsidiaries. And can you talk a little bit about this, Allison, and how, whether and how you can use provider relief funding throughout your big organization?
Yeah, so I think, and this is the really just simplified rule of thumb, and we'll get into more detail, but the rule of thumb is general distribution fundings can be reallocated. Targeted fundings cannot be reallocated. So even if a parent were to receive targeted funding on behalf of a provider who is eligible for that funding, the control and the use of that targeted funding must go down to that quote targeted provider. And that's just so that specific provider for that purpose is spending the funds. But I know that brings up a lot of issues for general distribution funding is, well, once we reallocate it, how do we report to it? How do we attest to it? So there's a lot of HHS FAQs on that. And I think the rule is that the parent, it sounds like they can attest on behalf of their subsidiaries, and they can reallocate. You can reallocate down, and you can down to a subsidiary, and you can reallocate up back up to the parent.
That's really helpful. And I think, and this harkens back to last week's podcast on transactions, is I think there was a slowdown a bit in the beginning of the pandemic, but there's a lot of activity on the transactional side. And maybe you could just take a minute to talk about when there's a change of ownership or a sale, how do you deal with these provider relief funding issues?
Yeah, that's a really good question. So there are definitely strict rules on what you do. Generally, if it is a change of ownership, a true chow with Medicare, you can't transfer the funds to the new buyer. So this helps wrap up their use of the funds, figure out where they are. If it is a change of information or a CHOI, there it looks like you can transfer the funds, since the buyer is essentially assuming the provider entity that holds the funds.
Okay. And you are the queen of chows and choys, which could be a whole nother section, but or session. But you are.
No, I was going to say some transactions that we're doing where we're buying hospitals right now. Just it's a whole another set of due diligence for relief funds or PPP funds. So this is going to be, you're right, it's going to be a whole nother layer for transactions.
Yeah, no, that's helpful. So tell me, I guess each of you, Eddie, 2 cents about what changes you think might continue to happen here, or what changes would you wish happen because you're losing sleep over it, and in terms of there's so much gray there, I don't know how to advise people.
Allison?
Well, I was going to say, other than the lost revenue, because I think that's what everybody's saying on the call. Dan, and I'm curious because you mentioned that you had been able to be on some regional HHS calls or CMS regional office calls. Do you think they're going to give more guidance on the lost revenue, or is this what we have to work with?
Here's actually, I do believe we'll continue to see more. They seem to be they have been very responsive in, questions that are not, so nuanced that it's just a kind of an answer for one. They've been really responsive in the questions that come out in a meaningful way. And we see several in the 55 pages of FAQ, several of those questions were questions we know we posed over the period of time. And I would encourage everyone to continue to submit those questions. And sometimes it gets a little frustrating because you're working on it right now and you're trying to either close your books or, make a decision, and the responsiveness is not always as quick because you're waiting for the FAQs, but it's still important to pose that question. I would also say a lot of times, and I think I've helped with some of your old clients, where we've had to escalate it to the regional director. And don't hesitate to reach out to your regional director for HHS. You can go out to the HHS website. All their contact information is out there. I think I've provided a link a couple times. And have the conversation. They really do want to help navigate this with you. So I think that's really important. The other thing, when you think about tea leaves, Meg, the one area that I've been really kind of trying to wrap my head around is on page 9 at the FAQs, there's a conversation in the lost revenues area regarding estimated expenses, which are basically in the months of March and April. I think it was March and April. And these estimated expenses, this area is really nuanced because I think it's creating some confusion in the marketplace, because everyone's talking about lost revenues in a calendar year period over a calendar year period, or 2 quarters versus 2 quarters, right? And this particular area is nuanced in the way that it's, I'm referring it to as we'll create another phrase like, but if for COVID, we're going to call it the keep the lights on phrase, right? So basically what it's saying is, and it gives several different areas here, and I'll read them right off on page 9. Expenses that, you had to incur to keep the lights on, specific in this period of time for example, you had elective surgery shut down, and you had other things that were shut down, maybe because of the state that you're operating in and so forth. They're recognizing these expenses around employee and contractor payroll. Obviously, there's a PPP offset to that. We discussed that earlier. Employee health insurance, rent and mortgage payments, equipment lease payments, electronic health record licensing fees, which could be pretty sizable, especially some of the medical facility, health system facilities. But all of those things, what they're saying is that you can estimate the costs associated with those things during these period of times where you had to close down as specific expenses. So I think that's a really, really interesting mathematical assessment because, when you're going through expenses first and then into lost revenues, probably an area that you really want to examine, and hopefully they're easy to estimate. I think things like, mortgage payments or rent or, licensing fees and so forth. You probably have some contractual documentation supporting and justifying those things. But I think it's an exercise everyone really should go through. And this is something that just came out on the 28th. And it's taken us a few days. And I was joking earlier prior to we got in the call. It's like it took me to almost right before getting this call where the light bulb went, okay, I get it, what's going on here. And so I have a call today with HHS at 3:00. So I'm going to further dive into that one because I think it's pretty interesting. The other thing going forward is in this whole area of vaccinations, we just responded to a RFP on helping a state set up and implement their vaccination inventory and distribution system. Because as you know, this is going to be pushed out to the state level. So, personally, just as a person, as an American, I really hope, and it was like one of these, rapid fire, give us your proposal kind of things. And can you start implementing right away if you win this bid kind of thing? And I really hope that is signaling that we have something material coming, right? I just hope as a person, right, is that for my family and for my friends and for all of you on the call. And what's pretty interesting though, if you think about that, if that is going to start happening, there's a whole administration cost associated with that. There's a whole cost associated with setting up preparedness for that. Again, expenses incurred because of COVID and treating corona, the definition. So I would start thinking about that as well. If you had to prepare or wanted to become part of that landscape, that would be an acceptable use of proceeds. But there's a nuance to that. So it wouldn't be administering vaccines, for example, for a Medicare patient, because that has a revenue tied to it. But if the cost of administering that, maybe you're serving a community or so forth, and you still want to administer vaccines to the uninsured, all those kind of there's an expense built up, and you're carrying out your mission and serving the communities you serve. So that's another area as I think about the tea leaves question, those are some areas I would think about. And then third areas, I'd work with your external auditors on just making sure as soon as the supplemental guidance comes out, in regards to single audit and external audit requirements, that you're really on top of that right away, because the window keeps on narrowing to reporting requirements. And some of you that have those fiscal years that don't align with calendar year, it's important to be on top of that.
Great, that's helpful. And I think for my hospice clients, we'd like some clarity about fundraising, and I know we're trying to do advocacy around that, and you and I are trying to work on that, but that is something that we still haven't gotten answers to yet, because for our not-for-profit hospices, that does play a pretty significant role sometimes in lost revenue. But so I wanted to move on before we get to our exciting rapid round of top 5 tips. I wanted to touch on reporting, auditing, and government enforcement. And I've been noodling on the whole government enforcement aspect of this as we everything we've talked about today, there's all this ambiguity and none of this is happening through rulemaking. And I think both of you have alluded to the contradictions that exist in FAQs. And so there's flip-flopping contradictions, ambiguity. And so I think this enforcement is going to be interesting. But before we get there, Allison, you had talked about the reporting timeframes, just to put that a finer point on that. So the first report is due when?
It is due, so the system that HHS is building to report this opens on January 15th. It was originally supposed to open in October, but that's been pushed back. So January 15th is a date that you need to mark your calendars to get in the system and kind of figure out how to walk through reporting. But reporting for funds expended $10,000 or more is due on February 15th of 2021 for funds used from January 1st for the calendar year of January 2020, basically.
So, and this, when you say getting on the site to familiarize yourself, we have no idea what that reporting is going to look like, what fields there's going to be or anything like that.
No, I mean,
is that right?
That's correct. We know what they think is allowable expenses and how to calculate lost revenue, but it will be curious just kind of how you go through all the different fields. And I imagine it is going to take a ton of time for the first round of data entry that's due on February 15th.
Yeah, I'm thinking so too. And I could see some very harried folks calling us because there could be some unexpected fields or something. So that could be a very busy time. On the audit side, this is an area too that Dan, I don't pretend to know much about the single audit versus the other type of audit, and on our tip sheet we have some distinctions about those two different types. But can you talk a little bit about those two different types? And you've referenced a couple of times that the guidance that governs these audits hasn't come out quite yet, and we're waiting for those. Can you just sort of summarize that auditing component?
Yeah, I'd be happy to, Megan. Yeah, and we're just waiting on a supplemental. Every year a supplemental comes out to how to do this. So many of you who have dealt with various federal related grants, used to be called a 133 audit. It's now called single audit. And there's just the way to think about it, in kind of, just high level terms, is it's like your external audit, but it's just a lot more nuanced. It's a lot more deep as it relates to the terms and conditions associated with this funding. Okay. And so really that guidance that comes out is really important. We put together for you in the supplemental document that we provided, tried to outline some of the nuances there of kind of a normal audit versus a single audit. The important fact for people to know is that if you have used over $750,000 of funds, which I would imagine there's a lot of people on this call that have, that you are going to be subject to a single audit. And the other important thing, the question that we get, which we don't have an answer for yet, is if, typically a single audit is for a not-for-profit entity, because those are usually the entities that receive grant fundings, right? So we have this new frontier that we're in, and that's for-profit entities who have received federal grant funds in the form of these PERFs. And so we don't know until that guidance comes out what the requirements are going to be for investor-owned organizations. We anticipate it may not be a full single audit, but instead some form of a federal auditing requirement that comes out in those supplemental guidance. So again, pay very close attention to that. We put in the document too, Meg, if you want me to go into kind of, we had 5 tips of preparing for that, right? Because that's something that you can do today. And first of all, understand the threshold. If you're over the $750,000, well, it's time to start planning. So work with your external audit, whomever's may or may not be doing your single audit. That time, it's usually the same. Talk about the time period, and so there's some time period attributes that Allison discussed, so be aware of that. Be aware of documentation. From day one, we've been talking about documentation. When you're in the throes of these things, especially the roller coaster ride that we've been on here, documentation couldn't be more important to support the decisions management's been making as you navigate this and knowing that you're trying to serve your communities. The last one is control effectiveness. Start testing your control effectiveness. Start keeping that. Test your move of funds controls. So, were your controls? Did you have any control breakdown when you took monies into your P&L? Was there any fraud occurring? All those kind of things, and we've seen a couple of those cases. And then lastly is data collection. Again, this gets back to documentation, but what's going to happen is that your single audit's going to occur, and then there's going to be this clearinghouse that it has to be submitted into. And there's going to be optics to that. And so leading a risk practice, I think about down the road, right? I think about the optics that for your brand reputation, an OIG auditor coming in and so forth, and that gets into a lot of the enforcement activities. Something in that preparation to think about, typically, we see areas like allowable and allowable expense activities. We spend a lot of time talking about that here today. The FAQs do a good job with that. Same with lost revenues. A little more moving part there. Cash management, for example, if you have the money sitting in an interest-bearing account versus not, and if you have to give some of those monies back, you're going to be required to not only give the base amounts back, but also the interest earned on those funds back. So having accounting for that's obviously pretty important. Your eligibility to attest terms condition will be examined. Your equipment and your property management, your leases, and then we get into this nuance that I was talking about of these 2 months that are keep the lights on, right? How are you accounting for that? So I won't go through them all, but in the document we've tried to give some tidbits and so forth. But if you have a question, just reach out to any of us, and we're here to try to help you navigate through it. And we're helping a lot of organizations out and just seeing a lot as we navigate this together.
Mm-hmm. Absolutely, that's really helpful. And I wanted to get your thoughts on government enforcement because it is keeping me up a bit at night because, and we have on our tip sheet, the various fraud and abuse laws that could intersect with these federal funds we got and how we use them. And False Claim Act, we obviously know that the penalties are very, very significant. And so I'll leave it open-ended is, I guess, what are your thoughts? What's keeping you up at night, Allison, related to enforcement? I think Allison might have frozen.
I think Allison needs to F5, right?
Yeah, she needs to F5.
This is something we learned the pre-webinar.
Can you hear me now? Sorry, it froze.
Yeah, there we go.
Yep.
There, sorry, it froze on my end. Okay. So we know that there is going to be a lot of oversight on this because they've doled out 175,000 or 175 billion. But I think we can break in the enforcement into 4 different categories. So under the CARES Act, they've created different levels of oversight. So we have a special inspector general who's assigned to audit and look into possible fraud. And that's really similar. So we don't know kind of how this is going to play out with enforcement, but I think we can look to the TARP program, the Troubled Asset Relief Program back in 2009, because they did a similar program where they appointed a special inspector general and they had a congressional oversight committee as well as an accountability committee. So it looks like the CARES Act is setting up kind of the government oversight in the similar fashion to TARP. And so I think we don't know if it's going to be exactly like that, but that's a good kind of historical basis. So that's the first kind of level of enforcement is what was set up under the CARES Act. The second level of enforcement is that from the government agencies. So obviously HHS is looking carefully at how their money is being spent, but we also have other government agencies who have made statements about looking into fraud. For example, we have the SEC who said they are going to look into potential fraud. And then we also have the IRS who has a webpage dedicated to funds received under the CARES Act. So I think there's going to be kind of a lot of, I guess, cross-examination or linking up different agency reports, making sure, your tax returns match up with the information that you're giving in the HHS portal. So that's going to be another issue. The third layer of kind of government accountability or enforcement is just the HHS audits. The HHS OIG has been tasked with doing random audits, and they are going to do a very stringent program of looking at how providers have spent these funds. And as anybody who's gone through an audit knows, it is painful. So again, document. Even I've gotten in the habit, even when a client just, sends a text or sends just an offhand email about like, what do you think about this use of the fund? I've been copying and pasting the guidance and saving that email, to the system in case it ever comes up. So we could say, well, on 10/28, this is what we based our answer on. So it was in good faith, at the guidance at that time. So I'd encourage similar controls just internally as well. And then the fourth kind of level of enforcement that I think we're going to see is the big one that you mentioned, Meg, is the False Claims Act. And also, where I'm worried about is just key time cases that are brought by whistleblowers, maybe disgruntled employees or maybe even the public, because how much providers have received is being made public. So that kind of puts a target on providers' backs. So it's interesting, though, because when you get in the False Claims Act, then you kind of have to look at what elements you need to make a false claim. You have to have the intent, you have to have the materiality. And I'm not saying this is an argument at all, but it's also that the guidance has continually been changing. So a provider may have based a decision on guidance, in May of 2020 that's completely changed until October. So how do you kind of rectify that? And is that a reasonable defense under the False Claims Act? So I will say we have all these scary things that are coming down the pipeline and that we need to prepare for. But I will say, or just point out, and I don't think this is supposed to kind of offer you comfort, but just to point out that the Principal Deputy Attorney General said this summer when asked, he said, we are really going to try to make good use of government dollars and not focus on these technical mistakes. And we're not going to pick up key TAM cases where there's a reasonable or honest misunderstanding. So again, I think that goes back to document what you're doing at each step, document the rationale behind it.
Yeah, absolutely. I think that's great. Great guidance. So we are at the lightning round. So we have 2 minutes because I told you I was doing this beforehand. So you're all prepared. So the 5 tips to sort of stay ahead, which I'm sure documentation is going to be on it somewhere. But I guess we'll start with you, Dan. What are your tips here as we close out in these remaining minutes?
Yeah, nothing's more important than documentation. So you hit that nail on the head, and I think we keep on driving that one home. My other tip is watch the FAQs often, measure them against the decisions that you're making. As Allison said, this is a friendly conversation, and we're working through the issues together. If this conversation's with an OIG auditor across the desk from you, if you've ever experienced it, it's not quite the same experience. So you want to be prepared for that. I think the other thing is management should always be considering the optics of this. And, the other thing to mention and think about is you're going to have for the not-for-profits on the call, which are quite a few, I think half, right? Or no, actually 70%.
Yeah.
You're going to have a community benefits report filing as well. And, a lot of times a big issue with community benefit reports filing is executive compensation. And that's something that's going to be pretty high optics in the time of all these monies, that taxpayer dollars that have flown into your organization. So just start to think about that. And then, don't don't be afraid to, get the expertise needed to assist you through the process. We see so many that are just trying to do it on their own, but the waves are changing so often. And, sometimes the benefit is, of having great legal counsel or accounting counsel or guidance, and is that we've seen a lot of things from a lot of different organizations.
Exactly. Yeah.
Navigate that with you is probably a lot easier. And those are expenses incurred. So, because you're incurring expenses because of coronavirus, right? And this particular specific nuance. So think about that. Not trying to be a sales pitch here, but we're seeing a lot, and there's a lot of questions out there, and the FAQs are great, but there's still interpretation that have to be kind of tested and navigated. So that would be my lightning round.
Great. And we're right at the hour. So before we close up, Allison, any additional thoughts to add?
Yeah, just I'll give a quick sentence. I think they involve your lawyers early. More importantly, involve your third-party auditors early. Most of my clients are for-profit and they haven't ever gone through a single audit. So I'm encouraging them to be in contact with their auditors and also go through a faux audit to make sure that you have the, required policies in place, or just kind of a prep for the audit, just since they haven't been through this type of single audit before.
Yeah, no, absolutely. And I think there is comfort but fear, and we're all working through this together because we're on uncharted territory. And so thank you so much, Allison and Dan. This has been a really great conversation, and thank you all for joining us today. I hope this was helpful these are areas where there's not always clear answers, but hopefully we gave you some food for thought. Join us for our next session for next Thursday on Pharmacy Trends 2021. And just to remind everyone, there is legal education hours. You just click that CEU icon at the bottom of the screen, and then you're going to get a certificate of attendance and a recording of today's session. And just to remind you, fill out the survey. We'd love to hear your feedback. And that concludes our webinar. Thank you very much, and have a very good day.